All right, I'm pressing go live.
Yeah.
Hi everyone, and welcome live Q&A. This time we're joined by CFA Jordan Lambert of Convexity, and as always, we are dedicating the next hour or so to answering your questions and discuss any interesting topics that may arise from the topics underway. I'm Jesper Beck. I am a UX designer and part of the portfolio team here at NewDeal Invest. Um, just send your questions in the live chat on YouTube, and we'll get to them as soon as we can. Obviously, this shouldn't be considered any kind of investment advice. We're just having a nice chat here today. But with me are Mads Christiansen, and I was thinking, just for the sake of new viewers, perhaps you could reintroduce yourself today.
Yeah, thank you, Jesper. I'm the founder and CEO of NewDeal Invest, a Danish investment fund that invests in tech stocks. We have a two-layer investment process. We look at tech, the tech they have. We like to find the leading companies within tech and invest in them, and then we do fundamental analysis, and that's our layer one. And then we've learned a lot about variance in tech stocks, and we have a lot of focus on mitigating that. So we have three distribution channels. We have the eToro channel. We're called NDI-FutureTech on eToro. Then we have a public listed fund in Denmark. The ticker is PMI NDI. And then we have the main fund, which is a non-listed fund where you need to invest a minimum 100,000 euro. So the subject is always tech stocks, and it's a great pleasure to have Jordan Lambert here with us today. Jordan is a tech specialist, CFA, and yeah, Jordan, you can introduce yourself.
Yes, thanks for having me on, guys. So yeah, my name's Jordan. I am founder and managing director of Convexity, which is a tech-focused equity research firm. And yeah, we founded in 2019, and so we have a mix of retail and institutional clients that we serve research for, investors who are interested in getting a deeper understanding of technology stocks. And yeah, so Convexity is a kind of consultant advisor to the NDI-FutureTech smart portfolio. And yeah, so it's so far going quite well. It's a nice partnership we've got going, and both learning from one another, and it's going really good.
Yeah, and I think one of the things we have in common is that we like to look at the qualitative things about the company, really focus on which companies has a leading tech, and thus trying to assess the long-term view on the companies, and then yeah, and go from there.
Yeah, yes, absolutely. Because yeah, it's I mean, you can do a valuation on a stock, and you may see that it's trading at a discount to intrinsic value, and you know you would expect over time that that discrepancy between price and intrinsic value would close maybe over 1 or 2 years. But what's kind of driving the returns after that point? And yeah, my view, our view at Convexity and at NewDeal Invest is pretty much, it's a deeper understanding of the technology that is going to drive long-term excess returns way beyond that kind of closing of valuation discrepancy in the near term. So yeah, that's kind of my view on how important it is to get a good understanding of the mechanics behind these tech stocks and what's driving them forward.
Awesome. So, guys, we have a few questions left over from last session. So I was thinking, hi NDI, will you please comment on Uber's latest Q1 and why the markets are sending it down despite growth? Should one be worried about Uber for the long term, or are you guys buying the dip?
Yeah, let me take that one. I just brought up Uber's chart here, and I think kind of a lot of the answer is there. Uber bottomed out around $20 in 2022, and it was up 4x from that in about a year. So that's a nice price increase. What's changed in Uber is that Uber's gone profitable, and that's really been what the market has been looking for. So coming from being a cash burning machine in 2022, market now sees it as a future, as a growth machine that is profitable, and that made this increase 4 times. But it's also been priced very much for that, so that it has to deliver. And this quarter, it came in at the low end of the guidance that the company gave themselves, and it was a little bit softness in Latin America. And I also think the consumer is a little bit weak right now. So it was just great expectations, and investors used to getting rewards for holding Uber, and now suddenly it's it's two sides, and so I don't think you need to put much into it. We have Uber doing a deal with Costco just recently, actually competing with Instacart there. Uber also coming on the Instacart platform to deliver pizzas and stuff via the Instacart platform. So I think Uber is a narrow and a more is a narrow aggregator of demand for mobility and for delivery, food delivery, and is doing a great job there. And I think they'll win together with DoorDash. Uber just bought the assets from Food Panda in Taiwan as well. So I think they're in a good place, profitable and growing, and a gorilla, what we like to see, their market leader or second to DoorDash. DoorDash still seems to take market share a little bit all the time. But Uber innovating and doing a lot of stuff. So I think Uber is a great company, and we've been buying a little bit on the dip here. Yeah, but would love to have it lower to be able to balance some more into it. Yeah, I guess that's it.
Cool. Did you also prepare a little bit about a question about PayPal? Or should I read it up for you?
Let's hear it. What was the question?
All right. So we have Mohammed asking, PayPal has just announced their Q1 and they are still showing growth. Could you just give me a few thoughts on the stock?
That's Paycom. That's Paycom.
That's Paycom, yeah.
Yeah.
So
PayPal.
There it is. Yeah. So PayPal is in fierce competition with Stripe and with Adyen and lots of other payment products. Also, Apple Pay is taking a dent in it. So money transfer is becoming somewhat commoditized, and it's a hard business. PayPal has the Venmo app, and is trying to leverage that against Apple Pay, but I think competition is hard, and to many investors, I think PayPal is the legacy player, which is not so innovative anymore, and thus I think the market is just questioning whether PayPal will return to good growth again, and we need to see that coming. One project I really think is good for PayPal is their stablecoin project. PayPal has distribution in so many countries, and I think they should be a really good sort of a player for that stablecoin bet. I actually think that X could also be be a good one if they decide to do a financial platform. But yeah, I'm not so enthusiastic about PayPal. Actually, I think it's hard to get an understanding of whether they're going to have a competitive advantage in that field. Do you have any thoughts, Jordan?
Yes, I kind of echo what you've just said. In the field of payment processing, they do feel like they are becoming somewhat legacyfied, especially with newer next-gen players emerging with less technical debt, being able to kind of move faster and just kind of provide a better user experience. My personal experience with PayPal recently, when I was opening a new account, it was a lot of friction. I encountered a number of problems, and which surprised me because PayPal were once a very a company regarded as just to provide a very good user experience, but yeah, I didn't experience that. So yeah, it kind of got me thinking a couple of red flags potentially with when you get to the size of PayPal, it's technical debt is inescapable, and it's just very difficult for them to keep innovating at the rate that they used to because of that. So yeah, I've not got too strong a view on PayPal either way, really, but it doesn't really
please explain technical debt.
So technical debt is just it's the amount of late code and that forms the software. Yeah, so when vendors start out, they will have a code base that's driving that software, and then over time, as that vendor will maybe make acquisitions and integrate third-party software into their main code base, it just creates complications, and then they might have to make that software usable in different environments, whether it's on-prem or in the cloud or wherever it may be. And yeah, as I say, just over time, it creates this technical debt, which is just, once you get the technical debt, it's really hard to untangle. There's Jim Keller is famous chip maker guru, and even though his specialism is in making chips, he has a lot of knowledge about software as well. And he says sometimes it's just easier instead of expanding into new markets by M&A and integrating new software into your core software. It's better just to start again from a clean slate. Because doing so will create so much technical debt, and just so that is what technical debt is, and it's inescapable.
It's actually when you listen to Adyen, the payment, the competition from PayPal, what they say about payments is that it's like you've had these pipes trying to come from one country and one person to another, and they've been stitched together or like this in a crazy machine with all different materials, different calibers and stuff, and it kind of works. But if you want to change something, it breaks there and there and there and there and there, and then so Adyen is likes to say that they are the new platform built without technical debt from one end to the other.
Yeah, completely can resonate with that. Absolutely.
Yeah, it makes a lot of sense. And speaking of technical debt and stocks we're perhaps not so keen on, we got a question last time from Hjalte, who asked if we have evaluated German SAP recently, or if there are other players in that software industry that might share a similar value proposition. And for that, I'd just like to share a few or a little perspective on it. SAP is an enterprise software company founded way back in the 70s, and it's actually really huge. It's the second most valuable EU tech company after ASML. It's just that no one really knows it, or it flies a lot under the radar because it's strictly B2B. So I do kind of understand why there might be curiosity surrounding a stock like that. That's certainly what got my eye on TSMC, for example, in the first place. But the problem with SAP is that it's very much a legacy business. They provide services that a lot of companies are really reliant on, but at the same time you constantly hear that they don't like dealing with it. It's convoluted, it's clunky, it's complicated software, and the specialists that usually deal with SAP solutions within companies are also famously very well compensated because it's just something that people don't want to deal with. And so they actually end up serving as a great example of a company that serves to be outside of our specific stock universe, because they're much more likely to end up being a company disrupted by the players that we keep an eye on, that are more innovative and more agile, and as Jordan just alluded to, perhaps are starting from scratch and building solutions that are modern today. And so those are the companies we follow instead. And I think a good example of someone very likely to eventually disrupt a company like SAP would be Palantir. It could also be some of Microsoft's newer AI offerings. But I know, Jordan, you have a lot of thoughts on Palantir, right?
Yes. So Palantir isn't in the NDI FutureTech portfolio at the moment, but we're monitoring it, right? And if price comes down a little bit further, it could be added in the next rebalance. Personally, I think it's could be one of the major growers in the future. And well, since 2021, we've been saying that they could potentially be the next Microsoft, which is a huge statement. But we're talking kind of 10, 20 years into the future. And for a while, Palantir was regarded as somewhat of a consultancy, not even a software company, if you recall. If anybody kind of has been following Palantir, dating back 2 years ago, many people thought it was just a consultancy firm, even though they was enjoying 80% gross margins, which no consultancy services based would ever generate 80% gross margins, but that's what a lot of the market believed. And there's a lot of pessimism around Palantir, that they're not going to be able to grow their business outside the government, and the government business was slowing, etc., etc. But since Gen AI came onto the scene, kind of late 2022, Palantir has been riding that wave quite significantly. And it's interesting because they released AIP, which is basically their solution to make a large language model work in an enterprise's environment. And when that came out, the market really responded positively to that, and Palantir's stock has skyrocketed. But really, AIP for Palantir's standard is quite a low bar of innovation. Really, it's kind of just the icing on the cake, because really the foundation of Palantir in what enables a large language model to work in an enterprise is their ontology, or the ontology that they can create for their enterprise customers. So that was already in place. So then when they released AIP, it really was just the kind of furnishings, just the icing on the cake. And the reason why Palantir is the best. The thesis for Palantir is they are really the only company that can make a large language model be effectively implemented into an enterprise in a way that is secure, high levels of governance, etc., etc. Because large language models like ChatGPT, they're great, right? Everybody loves using them. But it's not so easy just to take something like ChatGPT or Claude or an open source Llama and put it into an enterprise. And that is mostly because these large language models have been trained on the internet at large. The internet at large is made up of what we call ontologies. Yeah, there's various ontologies like RDF, OWL, good relations, or these type of ontologies make the internet what it is today, providing us with great experience, enabling us to search for information and interact with websites and retrieve information what we need.
And just for the listeners that might not know ontology, so ontology is the is how you describe the world to a computer program, and how the computer program can translate the output to something that's applicable to the world. So if you say orange, we humans, we know whether it's an orange or it's the color because of the context, but that's really hard to teach a computer program. And that's kind of, if you ask Alex Karp what their competitive advantage is, he would say we have the ontology. We are able to make a computer understand the business, how it works. There are so many gray zones in a business, and they'll be able to somehow make a computer get to that to make sense. So ontology is about describing what the world is like. Yeah,
that's a great way of explaining it, and you just made me think of an analogy. You need the ontology in order to make the large language model learn on the enterprise's data. So then it becomes really proficient in your enterprise. It becomes a domain-specific expert for your enterprise. An analogy would be like, consider somebody who has just graduated from high school. They may be 16, depending on what country they are in. And so they've graduated from high school. They've acquired a broad general knowledge about science, arts, craft, etc. But they're not a specialist in any subject. They just got general knowledge. This is what a large language model like ChatGPT for the consumer is. It's like that high school graduate. They've just got general knowledge. Now, just imagine that high school graduate now wants to start work life as an apprentice for maybe like an electrical contractor, and they join that electrical contractor, and they at this company they have 3 mentors. And imagine the first scenario is each of these mentors are talking to the apprentice about tools and methods and concepts in different terminologies. So each mentor is talking to him in different terminologies. It would be very confusing for that apprentice to quickly learn and progress in the job, because each of their 3 mentors is talking to him differently about things. Now, imagine a second scenario where the apprentice still has 3 mentors, but every mentor is talking in the same terminology when they're talking about the tools and the methods you need to do and concepts about the job. In that scenario, the apprentice would learn so much quicker and become very proficient in the job very quickly. So that is similar to applying a large language model into an enterprise environment. Not only do you need to make sure there's no data silos and all the data is migrated into a central location, all that data needs to be in a common vocabulary, common terminology. So as you said, they understand the context of one another. And if you can do that, then the large language model is going to learn so much faster and become very, very proficient for you in your organization. So it's not just good enough just having all data migrated from data silos into a central location. You actually you need that data speaking a common language, the language of the business. And as I say, that's why ChatGPT, the consumer-facing ChatGPT, is so good, because it has been trained on the internet, which is made up of these ontologies, which communicate about things in a common vocabulary.
Great,
So,
Jordan.
yeah.
So and I guess they have an advantage because they've been doing this for several years, and is there any competition that is kind of doing the same in the same level at the moment?
No, there isn't really. So some people have made comparisons between Palantir and Databricks. Databricks is a competitor to Snowflake, and they could be having an IPO within the next few years. Very, very likely, in fact. But Databricks, but for one, it's at a disadvantage because Databricks has come up from unstructured data, so kind of creating data lakes for enterprises, and kind of helping enterprises develop machine learning models off that unstructured data in that data lake. But really, what you need for large language models is they need to be fed highly structured and curated data. And that's something that Palantir has an advantage over Databricks, even though Databricks has moved over to structured data, kind of competing in the Snowflake arena. But also Databricks is also at a disadvantage because look, enterprises don't just want to deploy a large language model in their environment and have access to all of their data because of data privacy and security reasons. And that's another major advantage that Palantir has, because from day one, they had data privacy as their utmost priority. So if, for instance, if I'm using a large language model in an enterprise, I might not be able to access certain data because I don't have the authorization. But another person using that large language model could access that same data. Palantir can enable that granular access control. And because it just has a very good understanding of the data governance. But Databricks, Databricks, you wouldn't be able to do that. So that's a big advantage for Palantir. So really, we don't really have a like for like.
Going back to your analogy with the student, so it's like if you have a company, you just throw all the pictures and all the accounting books and all the products, everything into Databricks, and then you tell the young student, figure out what this company is and give me some answers. But Palantir will know what a business structure looks like. There's an accounting department. There are some rules. There are some investors. There are laws of the country and stuff. So they'll take the information in a structured way and make it easier, I guess. Jordan, I wanted you to just show us why we don't have Palantir in the NDI-FutureTech portfolio. I brought this one up, and can you guide me where you want me to click or?
Yeah, sure. So when you could see we last did this update, we updated this DCF valuation model on the 13th of March. That was just before we kind of got together to do the rebalance a couple of weeks before. And the current price at that time was higher. It was around
Probably
$25.
same
It
level
was
as now. Yeah.
it was
So
around
22.
$25. It was a little bit higher than the current price now. It was around $25. So because the current price was equal to the intrinsic value per share, which you can see in cell G4, it was kind of there wasn't any upside, the price matched the intrinsic value that we had for it. So and we had a lot more opportunities within our universe where we saw a bigger discount, where price was trading significantly below the intrinsic value per share. So essentially that's why Palantir wasn't included.
So you made this TCF chart and you made them for all our companies, Jordan, and you're really a wizard with Excel here. So we are able to put in here or to adjust what we think the long-term free cash flow margin is for the company, and we're able to adjust stock-based compensation. Long term, what we think it is. So if we look at stock-based compensation as % of revenue here, we'll see that we have the prior years, and then we have the guidance, and then we have the analyst consensus here, and then we can kind of fill in what we think the progression will be, and we end up at the 10% we put in here. So we can just see the effect of changing the long-term stock-based compensation. If they're really good and goes to 2.5, then we suddenly have the stock the intrinsic value of $34 and an upside.
Absolutely. And so the idea of that, since I've been doing valuations, especially when I started Convequity, I've kind of gone from really detailed valuations to more simplistic ones. So to begin with, when I started Convequity, I used to do full sets of financial statements, the income statement, balance sheet, cash flow statement, and making forecasts on every line. But over time, it was difficult to manage that for a number of stocks, and I kind of, through iteration, decided that this is probably the right blend of simplicity and detail, because ultimately the key drivers of evaluation is the growth, it's the free cash flow margin today and its anticipated trajectory, and also very important, it's the long-term free cash flow margin, often referred to as the terminal free cash flow margin. So that is ultimately the maximum profitability that you think the stock can have. So you can see here at Palantir, we as default, we have the long-term or terminal free cash flow margin set at 40%. And if you change that, that will have quite a big impact. So this is one of what we think we have an advantage at, because estimating the terminal free cash flow margin for a software or tech stock, you need to have a good understanding of the architecture, the underlying architecture of the stock, of the company. How is it utilizing cloud native paradigms, or is it more of an on-prem legacy type of software company, or anything in between? And you also the market dynamics, how competitive is the market, etc., etc. You can have if you have a good understanding of all that, you can estimate where the gross margin is going to go in its terminal state. Have a good idea on where you think sales and marketing as a percentage of revenue is going to go, also where R&D as a percentage of revenue is going to go, and kind of from that you can have a pretty good estimate on the terminal free cash flow margin. Also, where it's applicable, you can use comparables as well, like mature older companies that could be a potential comparable.
I really like this simplicity also, because when you're dealing with new businesses, it's hard to really get a sense of where we're going, like Palantir, you have some assumptions of what software companies can, what the zip code they can be in, but really this is a new company doing a new type of services for businesses, so it's really kind of hard to know where it ends and what kind of competition will come in. It's not like if you're investing in a new apple plantation, where you know kind of what do all the old apple plantations, what are their margins at maturity. So in tech, I think its simplicity enables you to be a little bit realistic and be really cautious about the implications you put into it. So I just wanted to show Carvana here to show how this is really a good tool also, because if you Carvana has been a company that has always been growing 100%, and now they did a makeover of the company, so they're not growing now, and analysts are projecting a somewhat low growth in the future, and we put in 10% growth here long term. So we can see that the growth here is waning off to 3%. And then we get an expected return of 36% over 2 years. But if we bump this up a little bit, then we suddenly get that it's underpriced, or it has 100% potential. And 20% is not that much because it's been growing 100%. I think it's going to grow somewhat more, at least something like 20-30% for at least some years, because they're coming from just 1% market cap, 1% of the market. So this is, just love the simplicity of what you've built here, Jordan, to be able to play with the numbers.
Yeah, absolutely. And I did one quite a accretive factor for Carvana's valuation here is just the stock-based compensation is already really low, and so it's going to stay low. So it's kind of not diluting the number of shares at all, which is very good for the valuation.
I think we should move on. Probably, have you picked a question, Jesper?
We actually have a whole bunch of questions from Sent, but I was thinking of just picking one of them, maybe a little bit along the lines of what we're talking about. So, given that we have Jordan with us here, I picked the one that says, "What stocks do you see as the most attractive right now, valuation-wise? Are there any places to get into right now at a good time?" Do we have some concrete examples in that, just speaking from pure valuation perspective?
Right. Well, one of my favorites is Monday.com. They are a high grower, and in the last several quarters, they have rampantly scaled up their operating margin and free cash flow margin. It kind of going back to some point in 2022, the market shifted from growth at all costs to wanting to see more about a balance of profit, or whether that's GAAP profit or EBIT GAAP profit, or non-GAAP EBIT profit, or free cash flow margin. Investors wanted to see a better balance. They wanted to see growth and also profit. And Monday responded to that very quickly, while many others, such as GitLab, Cloudflare, Okta, many other kind of best of breed SaaS companies, wasn't able to accelerate the profit as quickly, and also it suffered with a bigger growth decay. But Monday.com managed the growth decay better than most, and also accelerated that profit. And right now they have a rule of can I share my screen or not? Okay, let me share my screen. So just share the desktop. Where's the
Yeah, that's always the fun part, doing things live when we're a tech investment fund that we're struggling with the tech.
Right. Okay. I can't see the desktop, but
I
let me
was
just see if
thinking
that
about
works.
when we talked about SAP, that I
Yeah.
was when I was young, what you wanted to be was an SAP agent or specialist. They were really making good money, and all the companies needed them to digitize whatever they were doing.
Hmm.
Yeah.
Yeah.
Yeah. I think it's still
Can
the
you see my
case.
screen?
Yeah, it's working now, Jordan.
Right. Okay. So let's take a look at this rule of X. So right. So you just bear with me. Just
No
move that
worries.
out of the way. Right. So you can see this, right? So the rule of X, this rule of X has, in our analysis, has somewhat replaced the rule of 40. Rule of 40 is still important, but rule of X is an interesting variant where it's come from Bessemer Ventures. They did some analysis and found that actually stock returns are they are related to the rule of 40, but the rule of 40 is made up of growth and free cash flow margin, and stock returns are actually more sensitive to the growth component rather than the free cash flow component. So they created the rule of X, which takes growth and multiplies it against a multiplier, and then adds on the free cash flow margin. That multiplier is discretionary, but they say the median is 2.3. So you take the growth, times it by 2.3, and then add on the free cash flow margin, and you get the rule of X. That's kind of replaced our rule of 40 analysis. But we've also kind of gone a step further and adjusted it again by including stock-based compensation. So kind of free cash flow margin minus stock-based compensation as percentage of revenue. That is the calculation. And you can see here that this is sorted by the rule of X, including stock-based compensation. And Monday is pretty much right at the top. This isn't all of the NDI's FutureTech's universe, by the way. It's just kind of more specific to our equity research that we do for our clients. But you can see that Monday has a rule of X of 88. So financially, it's performed very, very well. A good blend of growth and free cash flow margin. But then you can also take a look at the multiples, and the multiples are fairly attractive as well. So the enterprise value to free cash flow minus stock-based compensation is not really that high compared to others. I mean, there's many other companies with a worse rule of X, but a much higher enterprise value to free cash flow minus stock-based compensations. Palantir is one of these. But that can be a bit noisy, especially for companies that have maybe not long broke even on a free cash flow minus stock-based compensation level. I like the gross profit multiple because gives you a bit more information than a sales multiple, but isn't as noisy as other multiples like EBIT or, as I say, free cash flow. And you can see that Monday's gross profit multiple here at 14 times is to me, I don't think that's expensive, especially considering that it has a stellar rule of X. So you can quickly compare the rule of X to the enterprise value to gross profit. You can quickly see value here.
So Jordan,
I would say
now you have this picture up here. Maybe there's a question about which cybersecurity company that you're most bullish on right now. I guess that should be a mix of, or maybe could you, there, I see some of them here. Could you sort of give your 2 cents on a couple of those?
Yeah, sure. So one that we are most bullish on is Fortinet. Fortinet is the thesis for Fortinet is well, our thesis is probably quite divergent. We're thinking much further ahead than what the typical investor is thinking. So Fortinet's most investors right now are thinking of with Fortinet's thesis is around how well we do in SASE. So SASE is a new paradigm for network security. You know, it's a software as a service version of network security. Instead of having firewalls on-prem, SASE is about kind of doing these security inspections in a pod in the cloud as the data packets move on to their destination. And Palo Alto Networks is a leader in SASE. So is Zscaler. But Fortinet is an underdog at the moment. But we believe that as kind of the network security industry kind of cools off and think like, well, we're not enterprises aren't going to become 100% cloud. You know, I think it's kind of become known now, it's become established that most enterprises are going to be hybrid. And so they're going to retain some of their on-prem equipment and some of their on-prem environment. So to do the SASE is all about converging networking and security together to make networking more efficient and also to make security stronger. But it doesn't have to occur in the cloud or in the POP off-prem. It should really occur wherever it's most cost effective to do so. And what Fortinet has, it has a very compact hardware appliance that can do this converged networking and security. And they are the only vendor that has this. There's no other vendor that has an appliance that can do the converged networking and security. Most other companies, even in the cloud, they have to service chain in all these various networking services and the various security services together in different boxes. And each packet will go through each of these stages, so it's service chained. But with Fortinet, due to their long-term investments in their custom silicon, they've been able to pack all the networking and security functions into one appliance and make it true converged networking and security. And they can do this on-prem in an office, in a data center, at a home office, or they can do it in the cloud. So what I've been saying for many years now is Fortinet is the most accommodative SASE player that there is. And what we call, we've actually changed the term SASE. So SASE, for viewers who may not be familiar, SASE is a Gartner term. It stands for Secure Access Service Edge. So meaning that it's occurring at the edge, in a point of presence off-prem. But we've changed that for our own into our own terminology, called it SASO, which is Secure Access Service Omni. And the Omni means that that convergence of networking security doesn't have to happen in the cloud, in the edge, in off-prem. It can happen anywhere, wherever it's most cost effective to do so. And sometimes it will be most cost effective to do the networking and security in the POP. But sometimes it'll be more cost effective to do it on-prem. So that's why we think Fortinet is very, very strong. And kind of not only that, we can go one step further. I mean, SASE is just the first mile of networking. Yeah. It's the point from where a user is initiating a connection to connect with a resource, whether that be in an on-prem data center or a SaaS application. And that connection traverses to the checkpoint, the inspection checkpoint, which might be on-prem somewhere, or it might be in the POP. So that is just the first mile. But beyond that, you've got the middle mile, where the data packet's going to traverse, and go through a number of hops on its way to get to its destination. And then you have the last mile as well. So the SASE is just the first mile. There's the middle mile and the last mile, and there's very few companies that are well positioned to take advantage of the middle mile and the last mile, assuming that the industry will eventually converge and consolidate. We've already seen this in SASE. 2 years ago, there was umpteen SASE vendors, and now there's only a few because of the M&A that's occurred. So naturally, you would expect these companies to start looking broader than just SASE, and looking at the broader networking landscape, which includes the middle mile and the last mile as well. Yeah, so companies
Jordan,
like Cloudflare, Fortinet are positioned very, very well for that consolidation. But this is really far ahead. You know, you're talking perhaps 3, 4, 5 years before this starts to materialize.
Thanks a lot.
Yep. All right. We have a question from Lucas asking for our thoughts on Rubrik. I think it's called Rubrik stock. Are you guys familiar with that one?
Yeah.
Supposedly
absolutely.
Jordan is an expert. Even the questioner says.
Yeah, right. So yeah, Rubrik, quite an exciting new IPO in cybersecurity. First cybersecurity IPO in over 2 years. I think it's very interesting. It's very different to any other cybersecurity company, because despite all the cybersecurity stack that enterprises have, they have network security, they have endpoint security, they have detection and response, they have all this stack, but yet we're still seeing ransomware. Ransomware gangs are still being successful and getting to data and encrypting that data, and then holding companies to ransom. Now, Rubrik's coming along and said, well, we can provide a backup for your data. So there's production data that a company needs on an everyday today basis, and then companies should be backing up all that data as well. So if there is a natural disaster, or there's an outage, or a massive human error, or ransomware, they can say, right, okay, our production data is in trouble, we can't use it, but we have this backup, so we can just use the backup and recover our production environment. So that's what Rubrik does. But interestingly, the backup and recovery market for decades wasn't concerned about cybersecurity threats, but it was only designed to quickly recover from a natural disaster or a power outage. So Rubrik's differentiation was to create this backup and recovery solution with a focus on ransomware, protecting an enterprise against a ransomware, because what ransomware gangs do, successful ones, is they don't only just encrypt the production data, they'll target the backup data as well and encrypt that. And there's been many instances where an enterprise has the backup data, but that data also got encrypted. So they just had to pay the ransom, or the business would have folded. So Rubrik has come along and said, right, this backup data that you have is resilient. They can't get to it. It's air gapped. Nobody can get to it. There's not even super users allowed to access the backup data. So that's how stringent they are. And they're so confident in their ability to protect any enterprise against a successful ransomware attack, is that in 2021 they offered their ransomware warranty. So if any of their customers got hacked and their data got encrypted, they would pay the customer $10 million.
Wow.
And there's not been an incident since. And so this was first of its kind, and nobody else has tried to match that. So
it's funny because it's so, we talk about cybersecurity being a hard sell because it happens rarely for a business, a large business. It's hard for the CIO to convince the management that this is really important. But then you come to a backup company, and that's maybe an even rarer incident. So it sounds like a little bit a hard sell, but I know they've also been working on doing services on the data now that they have it. So maybe it should not just be idle. And so how do you think about it? Is it a good investment now, or should investors wait, or is it going into our portfolio?
Yeah. So I think it's one to wait on. The thing with Rubrik is they've got some competition. It's the backup and recovery market isn't abundant of competition like something like productivity software for CRM or something like that. You know, but there is still some competition. And what Rubrik has to do is they have to look forward and be able to back up more data types related to SaaS. Yeah. So SaaS applications, they're like the Salesforce, they need to be able to back up that, which they can, and they can do Microsoft 365. But they need to add more SaaS applications. How more and more, like being able to back up more SaaS applications, all that data for their enterprises. But so they need to be looking. If we say the SaaS is still the future, they need to be looking towards the future. But if they are claiming that they are going to protect the world's data from ransomware, they also need to be looking in the past. And why I say that is they need to be able to back up data from legacy databases. So from like a legacy IBM database or a legacy Oracle or SAP, they need to be able to back up these databases as well. And they can't at the moment. But there's a lot of older backup recovery companies, such as Commvault, who's been around since the 1980s, or Veritas, which recently got acquired by Cohesity. These kind of older backup data companies, they can protect a wide range of legacy databases. So Rubrik's at a disadvantage to these legacy backup vendors just because they was only founded in 2014 and they're competing against backup vendors that have been around since the 1980s. So that's an interesting one. I don't really, you don't really encounter that in any other, in most other areas where you need to also be focusing on the legacy. Rubrik's considered a next-gen backup vendor, but they need to be thinking about backing up, being able to protect and back up these legacy databases if they're truly going to protect the world's data. Because as we said earlier, during COVID, there was a rush to be cloud first, and many companies are cloud first, but they're still hybrid. And if you're hybrid, that means you still got an on-prem environment. You still need to manage your legacy databases, which are mission critical. So if Rubrik wants these very large enterprises as customers who obviously have hybrid environments, they need to be able to back up and protect more of these legacy databases.
Okay,
All right.
so
So,
I just want a really quick. I've been thinking Qualcomm all the time while we've been talking. We talked about SAP, this legacy company where people doesn't like to work on their platform. I hear that about no, not Qualcomm. I'm thinking about the database company. What am I thinking
Broadcom?
about? No, the third cloud, the cloud, not one of the big cloud providers, but the fourth one, working with NVIDIA. What are they called?
there's
Supermicro?
Oracle,
yes, Oracle.
yeah.
Yeah, so Oracle, yeah, so people say that it's cumbersome to work on and they're legacy, but yet they are working with Palantir now and NVIDIA and stuff. How do you see Oracle, Jordan? Just very shortly.
Yeah. So yes, Oracle, obviously their core is what you call OLTP databases, so the transactional databases dominate in that market, and they're done well expanding into the cloud. And striking up these partnerships. You always hear that Oracle is striking up these partnerships, and but the revenue base is so high. It's you just think, is it ever going to move the needle? The cloud does have some strengths, but also has some weaknesses, and it's not really ever going to match AWS or Azure. But yeah, I think it'll be interesting to see, because they've invested a lot of capex, pushed down their free cash flow margin recently. It'll just be interesting to see if that is going to deliver improved return on investment and push the price higher. But as I say, I hear a lot about these partnerships, but it's all incremental. I don't see anything really moving the needle. Yeah,
I think your answer just illustrates what we're talking about here, how difficult it is to predict where tech is really going in just a couple of years out, and it'll be important if they are able to keep being on the edge, or just somewhere near the edge, leading edge, to be able to prosper long term.
The thing is with Oracle, it's Oracle like SAP as well. I mean, people kind of complain about having to use them, but they're so entrenched and they're not going to go anywhere. They're so entrenched, and they are related to data, and we know that we are going to see an explosion of data over the next few years, especially driven by Gen AI. So even though they're legacy and people don't like using them, they are going to be a beneficiary, but it's just there are going to be greater beneficiaries, and that's the ones we like to try and include in the portfolio, right? But yeah, they're so entrenched, they should benefit.
Yeah, it's really interesting. Like, imagine if some of these legacy companies actually manage to sort of reinvent themselves here and all this AI craze, like a revival of SAP, IBM, Oracle. That'd be crazy, right? But I think we're gonna close down for now. We're a bit over time, so it's been really great having you on, Jordan, this time. Hopefully, we can get you back sometime. There was a whole lot of questions directly for you, so I think that's a great response from the community. Either way, we'll be back again for another live session in a couple of weeks, you guys. Thanks for asking questions. The ones that we skipped today, we will of course try and get to next time. I hope you all have a great night, and we'll see you next time.
Yeah,
Say bye,
great
everyone.
having you here, Jordan.
Yeah. Bye, guys. Thank
Bye.
you. Bye.